Hi guys, good afternoon and welcome to Mutual Fund Corner. I'm Pavitra Parekh. With me is Sonal Bhutra, and today we're going to talk about having some kind of debt exposure in your portfolio. This is a topic that we have touched upon before, but today we're really going to get into and get you an in-depth understanding of long duration bond funds. Sonal, this is even more interesting at a time like this, when interest rates are on the rise.
Oh yes, another one that came by yesterday, 35 basis points. And to discuss this, all about long duration debt funds, we have with us our Sivakumar from Axis Mutual Fund and Raghav Iyengar as well from Axis AMC to discuss the outlook on these segments and how one can actually invest into this as well. Gentlemen, good afternoon. Thanks a lot for joining us. Raghav, I have to start with you on this one because we often talk about how all investors should have some exposure to debt, and especially in the rising interest rate scenarios as well. How do you assess how much you should invest here?
Thanks so much for having me on the show again. I think debt mutual funds are a little complicated. I think thanks to efforts of people like you, we've been able to educate people on the volatility that exists in equity funds. But in the debt space, I think what worries many investors is the volatility, right? And I think debt has to be a part of every investor portfolio because I think and all of us know this, debt markets and equity markets are very, very different in their behavior. So you have to have a little bit of debt to sort of cushion the shock of anything happening in the equity market space. And over the last, if you take especially over a long-term investment horizon, both of them effectively try and give you very, very similar returns, right? Obviously, I think the key thing in debt, what many people do, in my opinion, which is wrong, is that they don't marry their investment horizon with their investment. So, shit. Oh, shit.
Okay.
Oops.
Okay, all right, Raghav, we do take that point and we'll come to you. But, of course, Patra, considering that how the rate hike cycle has been in last couple of days, we are seeing rates at the highest level since 2018. We're just speaking to a real estate player as well, and they did say that, yes, at some point in time, it start hurting demand. But, of course, that's a good news for investors into the debt funds, and we'll keep discussing that. I just think there's some technical issues, so to say, but of course interest rates, a lot of interest sensitives as well, be it the auto sector, be it the real estate sector, and definitely last couple of conversations that we've had on the show, we have discussed how having a debt component in times like these, when we are seeing so much market volatility across the globe, it's a good component to have in your mutual fund. And we've gotten experts as well to tell us just that, be it target maturity funds, be it long duration debt funds as well. So we'll keep discussing that. But for now, of course, that's the big theme that everyone's talking about.
Oh, absolutely. Every guest that we've spoken to has just emphasized time and again on the importance of having some kind of debt exposure. So I think that point is well taken. How much you should have is, of course, dependent on your own kind of portfolio goals, the kind of risk that you can undertake. But this is a good way to kind of also balance the risk that you have, right? Equity investing is considered risky. So in that situation, to have some kind of debt exposure is always a good idea. And that is what we're going to talk about as well. We have our next guest also joining us. R. Sivakumar is also joining us from Axis. Mr. Sivakumar, thanks a lot for joining us. I'm Pavitra. Sonal is also with me. And we were talking about long duration bond funds, and we did have Raghav briefly sort of mentioning how it is important to have some kind of debt exposure in everybody's portfolio. Of course, the amount can vary. So now I have a two-part question to you. How do you really approach debt in a rising interest rate environment? How do you go about investing given the fact that increasing interest rates could, of course, impact the market? And second, there are so many debt fund categories. How do you pick which one is the best one for you?
Hi, thank you first of all, and I think this is a very important question when it comes to making an investment decision, that what segment you want to be and how much you want to allocate. And the easiest answer to this is allocate basis your own investment need and time horizon. For example, if your horizon is 6 months or 12 months, I would suggest do not buy a long duration fund. You should buy a fund which is in the money market space or a low duration, ultra short, etc. And if your horizon is, let's say, 5 years, 10 years or more, certainly consider much longer duration portfolios. And everything in between. If your horizon is 3 years, you could consider short-term funds and so on and so forth. So the most important thing is to look to match your investment horizon. To answer your other question, which is what happens when interest rates rise and therefore could have some impact on your portfolio, we must always remember that when we are making investments, we want interest rates to go up. because that's the kind of rates at which we invest into our portfolio. And when we want to redeem or when we are in the process of exiting, we want interest rates to be low. And in the current environment, as rates have gone up, certainly the yields on government securities and other bonds have risen over the last 1 to 2 years. And it's therefore a good opportunity today compared to any time in the last 2 years to get deployed into longer duration securities. So I think from an investment perspective, today is definitely more interesting than any time in the last couple of years.
It is. So, Mr. Sivakumar, in that case, the next question really is that right now we are seeing FD rates as the fixed deposit rates around 7.5% or so. So, why should one choose a fund, a debt fund over a simple FD, especially considering that they come with some market risk? Is the tax benefit the main reason to pick this category?
Yeah, there are a couple of reasons. One is Government of India long duration securities are themselves offering you yields of, let's say, 7.25 or higher. And so these are sovereign securities where the yield is comparable perhaps to FDs offered by NBFCs and other bank FDs are still much lower than that in terms of yield. So firstly, I think for many investors, I think it does make sense to look at market instruments, because in this period of rising interest rates, we've seen yields on market instruments such as bonds and government securities rise much more than the rise in deposit rates. But that's part of the story. And the other part of the story is that what is it that you're using this for? Like I said, if you are parking money for very short term, certainly a deposit might make sense. But if you're really looking to invest for 3 years or more with the benefit of long-term capital gains tax in mutual funds, definitely you should be looking at a mutual fund type product, even if the yields are somewhat similar to the alternate deposit products.
All right, got that. Also, Raghav is back with us. So, Raghav, I think there was some technical glitch, but I hope you can hear me now. And, we were talking about long duration funds, the different categories within debt schemes as well. And you yourself are launching a new fund, which is a long duration bond fund. So, take us through who you think this category is best suited for. Of course, they have to have a long time horizon. We know that. And what do you also see as the key benefit and case for investing in this category over any other?
Okay, I don't think I'm going to go backwards, Pavitra. I'm not going to. There's no. I mean, all debt investments at this point of time are great investments. In this particular category, what we are trying to do is trying to figure out. Ideally, an investor who's got a 10-year plus investment horizon should come into this fund, because this fund is typically going to buy very long duration bonds. So ideally, this is like a beautiful way to create what I call in some sense, a second income fee. You could use either come in as a lump sum, invest over 10, 15, 20 years, not worry about, volatility in the debt space. In that period of time, people are very worried about price movements in the debt market. Should not worry about it. Don't look at your NAVs on a daily basis. Just keep investing. I think like Shiva mentioned, you have government securities now which are available at over 7%. They are very, very attractive returns. And I think over a period of time, I think when your corpus accumulates, you could use the SWP option, the systematic withdrawal plan option, to sort of give you a consistent flow of cash flow over the life of the investment, right? So it's a great, in some sense, it's a great starting tool. I think anybody who is ideally in this investing, like every other investment, the earlier you start, the better it is, but perfectly suited for someone in the 35 to 50-year-old range. Someone like maybe me, ideally should be putting some serious money into this product.
Raghav, just a few more details about the fund, because we want to know what does the credit profile of the fund look like and what is the level of liquidity risk here?
Oh, this is okay. This is a long duration fund. So by definition, it means that we'll have to invest in a portfolio having a immaculate duration of more than 7 years. Typically in this investment bucket, you get largely government securities only. So in terms of safety, absolutely, you're at the lowest level of investment risk. Safety risk. And of course, in terms of liquidity, it's a government security. So very, very easy to, there's a very deep market that exists for government securities in the country. So very, very easy to liquidate securities at any point of time.
All right, that would also be a key benefit of this kind of investment. But Raghav, Mr. Sivakumar, I request you to please hold on for just a few minutes. We have to get into a mandatory commercial break, but we're going to come back in just 2 minutes and continue this conversation on long duration.
Welcome back. You're still tuned into Mutual Fund Corner on CNBC TV18, and we still have with us Mr. R. Sivakumar and Raghav Iyengar to answer all your queries with respect to long duration bond funds as well. Mr. Sivakumar, let me come to you, because we have been talking about the rising interest rate environment. That's all we've been discussing for the last couple of months as well. How sensitive are these funds to interest rate changes, and how would you compare them to, say, any other debt funds?
Naturally, long duration funds, by their very nature, are going to be very sensitive to interest rate changes, or rather changes in the yield on long duration securities. But herein lies a very interesting conundrum. So how do you know where do yields on long-term government securities go? Well, just give you an example. Over the last 6 months, from June to now, the yield on 30-year Government of India securities has dropped from around 7.8% to 7.4%, despite the fact that the RBI has been raising rates. Now, this is interesting because it means that the market in some sense is going against the RBI. This happens in a situation where typically the market anticipates the future course of monetary policy action. And in this case, there was a lot of expectations of significant rate hikes, which got baked in as soon as the RBI started raising rates. But over time, what has actually happened is that the market has probably changed its mind a little bit, and yields have actually softened as you get closer and closer to the end of the rate hike cycle. The yields have somewhat softened over the last 6 months. And therefore, it's important to keep in mind, one is where interest rates are headed, but much more important is that the market tends to upfront a lot of this, and therefore you don't have to wait for RBI to raise rates in funds like this. The volatility will be there, but the volatility is very easy to manage as long as your holding period is reasonably long. When we talk about greater than 7 years duration, and when you look at very long duration Government of India securities, 30, 40-year securities, the duration is much higher, 13, 14 years or more. So naturally, it's going to be volatile for someone with a very short holding period. But if your holding period, as Raghav just mentioned, is going to be 10 years or more, then that duration risk is significantly attenuated. And I think that is the way to look at a product like this, that you need to have very long holding periods so as to manage your interest rate risk. Don't look at market entry points, yield entry points, etc., because interest rate cycles in India tend to be maybe 3 years, 5 years. And if your horizon is 10 years or more, then you may well go through 2 interest rate cycles, 3 interest rate cycles by the time you're coming closer to your target holding period. And thus, what happens in the near term should not be making your investment decisions. Please take when you're making investment decisions in long duration funds, have an approach of holding for long periods of time. You may want to do an SIP type of an approach also, wherein you invest staggered way over the next few years and then look to build a corpus in a portfolio like this.
Okay, got that, and that point is well taken. Since you mentioned the government bonds as well, I am going to ask you about the Bharat Bond ETF in just a bit. But for now, sticking with these long duration funds, there are so many options that you could pick. So how do you pick the best fund in this space? If I can come to you, Raghav, on this one.
This best fund stuff, Pavitra, doesn't work. I think ideally you need to pick a fund which has a good track record, good management track record, obviously comes from a reputed brand, and more importantly sticks to what it says it will do. And that's broadly what, if you look at what we want to do, for example, in the Axis Long Duration Fund, we're very clear that we want to go and buy about a 30-35-year bond. And we'll continue to keep, rolling down or reducing the duration as somebody's investment horizon gets lower and lower. So I think most people tend to do this stuff of looking at 1 year, 2 year, 3 year returns. I don't think that's the way to do it. I think one way to do it is to obviously look at how rolling returns have worked out. Number two, how the funds have done in periods of volatility, especially there's so much of it happened in the last 2 years. And lastly, of course, I think look at the portfolio, look at the credits, look at the people behind the fund management, the people behind the AMC. And I think that will give you some comfort.
Okay, point taken there. Mr. Sivakumar, something we spoke about briefly earlier also is the taxation of long duration funds. You also spoke about it being a key benefit as well. Can you explain the extent of the benefit a little more? How can it be something of a pro that investors can look at?
Yeah, this is only a little bit important. And I think because the Government of India, as things stand, taxes you on the adjusted capital gain, that is to say, adjusted for cost of inflation. So which means the tax that you pay is 20% of the incremental gain over above the rate of inflation. So over the last maybe 10 years, maybe we've had average inflation of close to 5%. If that is the case going forward, then up to 5% return is protected, and your tax of 20% applies on any return over that. So if your return is going to be 7% per annum, and your cost indexation is 5% per annum, you pay 20% tax on that additional 2%, which is 40 basis points. So your return drops from 7 to 6.6%. If the inflation rate in India drops to 4%, then you will be paying 20% tax on the 3% incremental rate of return, and assuming that the rate of return remains 7%. So obviously there are assumptions about the rate of return, assumptions about the inflation. But the idea is that the tax is paid only on the incremental over the rate of inflation, or what's called the real rate of return. And I think which is very fair, because effectively what that means is if you assume the inflation rate of 4 to 5% going forward, then your tax rate comes down to perhaps, say, effective tax rate comes down to maybe 6 to 10%, which I think is very, very competitive compared to other long-term savings products.
Oh, yes, absolutely. This is something that we have spoken about before as well, the tax benefit of investing in such a fund. Mr. Sivakumar, coming to you once again, we had the central bank's rate decision yesterday. They have raised rates as expected by 35 basis points. Your reading of the policy decision, and how do you think the central bank is likely to act going forward at the next meeting?
Interesting is the RBI has set out some very specific objectives that firstly is to get inflation first below 6% and eventually on track to get close to 4% over the next few years. So that means we should expect interest rates to remain reasonably high going forward. The second is that, of course, RBI is concerned about external factors, including what the Fed will do in terms of the terminal rate. And therefore, we have to be a little bit watchful for what's happening in the rest of the world. And there's a little bit of comfort there, given that yields in developed markets have materially dropped in recent times, with the assumption, therefore, that in the next year or so, you may actually start seeing rates coming down in some of the developed economies. So what that suggests to me is that while we should still brace ourselves for further rate increases, perhaps one more hike, maybe two more hikes in the next couple of policies, we are now very close to the end of the rate hike cycle. And when you take a longer term view, 1 year, 2 years, 3 years onward view, I think we should probably peak maybe at about 6.5%. And then the market mood will shift to looking at when the rate cut cycle will start, as and when that happens. So we are probably very close to the peak of the rate cycle. And I think the RBI is going to be very data driven. And it's not just RBI. Global central banks have got the call on inflation so wrong last year because of rising commodity prices, geopolitical events, and so on, that they will be a little bit wary about cutting rates as and when that cycle starts. So I think it's, let's not get overexcited. Let's not think that rate cuts are just around the corner, but as we should cheer the fact that we are coming very close to the end of the rate cycle, the up move in rates, I should say.
Okay, got that. Just one final question before we do wrap up on this show is on the Bharat Bond ETF that I was mentioning. The new fund offer closes today, which is on the 8th of December. This is a passively managed fund. It tracks the Nifty Bharat Bond Index, and indicative yield is around 7.5%. Mr. Sivakumar, do you think this looks like an attractive investment? Long holding period, around 10.5 years.
I think when you look at I wish this. I'm very happy that this category of funds has been created, of these roll down index strategies, which is given a new way for investors to invest in what looks like sort of open-ended FMPs with much greater disclosure about the quality of the portfolio, ITMs, etc. So if you have that kind of holding period, and if you're comfortable with the portfolio, great. It's a very, very good way of investing, whether you invest in the Bharat Bond, or whether you invest in any of the equivalent products offered by Axis or any other mutual fund for that matter. Everybody is in this space. The differences are going to be very minimal, and I think there is a great reason for investing in these instruments. They are very different from open-ended funds in the sense they are passive roll-down strategies. So therefore, look at this only if you have a clear thought process that you're looking for quasi FMP kind of a roll down fixed tenor approach. And if you are looking for active strategies, and I think there is still a large case for active management in debt in India, given that we're not really a developed market with well-researched market conditions like we have in equities. We still see lots of opportunities for active management in fixed income. So this should just form one part of your debt portfolio, passive roll-down strategies, and you should look at balancing your portfolios with across active as well as passive strategies.
Okay, so that's a masterclass on long duration bond funds. Mr. Sivakumar, Mr. Iyengar, thank you so much for joining us, explaining to us the benefits, what should the risks associated be with it, and what should an investor look out for as well. That's all we have on the show today. Stay tuned for Closing Bell to take you through the last hour of trading session. Stay tuned.